Two major banks coming out proactively to clarify the situation regarding interest rates on loans to their clients. Confusion still reigns days after the president signed the interest rate capping law, with debate raging on everything whether the KBRR or the CBR is the applicable reference rate and whether the law applies to existing loans. The new law, it seems, has created more heat than light. Here's Abiagina with more.
Cooperative Bank and the Kenya Commercial Bank are the first two financial institutions to come out to clarify that they will follow the letter of the law and are complying by adjusting their lending rates downwards to 14.5% following the ratification of the law. Cooperative Bank, in a statement to customers and to newsrooms, said in part, "In the foregoing and for business continuity, we advise that pending receipt of full guidelines from the Central Bank of Kenya, all new credit facilities will be applicable at base rate not exceeding 14.5% per annum." KCB, on the other hand, states in a text to customers, and I quote, "In reference to the Banking Amendment Act, all new loans are capped at 14.5% effective today. Guidance on existing loans awaits direction from CBK." End of quote. In all, the move to communicate thus with customers should be laudable. But wait, the lacuna over whether the applicable reference rate in the law is the KBRR at 8.9% or the CBR at 10.5%, meaning that both KCB and Cooperative Bank could still be overcharging clients by up to 1.6%. According to experts, the new law as is refers to the Kenya Bankers reference rate, meaning that both Coop Bank and KCB could be in breach of the law already just days after it was created. While the debate continues to muddy the waters, banking regulator Central Bank has so opted to stay tight-lipped and is yet to take an official position on the operationalization of the law. Then there's the debate on whether the law applies to pre-existing loans. According to Wilfred Onono of the Interest Rate Advisory Center, every borrower now has a right to ask for a recalculation of their existing loan, exposing the banking sector to a truly horrific legal and actuarial scenario.
Basically, what the law is saying is that instead of leaving the banks free to determine the premium they put on the base rate,
yes,
the Act has now said that premium on base rate is a maximum of 4%.
KBA, however, has its own stand on that matter.
Operationalization has not been effected. So far, the existing loans will continue to exist in the books on the basis of the existing terms and conditions until the new law comes into place. Now, if that new law will require the existing loans to be repriced, so be it. If it will only apply to new loans going forward, so be it. But whichever way it comes out, banks will have to comply.